Moving averages are the topic for discussion in this video lesson. Moving averages are a very simple yet highly effective tool in technical analysis. They smooth out a data series and make it easier to spot trends. Moving averages also help form the foundation for many other technical indicators and overlays. While moving averages are not suited for predicting a change in trend, they do help identify and confirm a current trend. Moving averages consistently come into play because a stock can essentially do one of three things: trend up, trend down, or trade sideways in a range. Just to be clear, an uptrend is established when a stock has formed a series of higher highs and higher lows. Inversely, a downtrend is established when a stock forms a series of lower lows and lower highs. And finally, a stock trades sideways in a range when an uptrend or downtrend cannot be established. If a stock is in a trading range, an uptrend is started when the resistance or upper boundary of the range is broken, and a downtrend begins when support or lower boundary is penetrated. Now, since it is common for stocks to trend, and it is considered a good rule of thumb to always trade with the trend, identifying what the current trend actually is becomes extremely important. Therefore, effectively utilizing moving averages greatly assists most trading styles. Take a look at this stock chart of Continental Airlines, ticker symbol CAL. The yellow line on the chart is the moving average. Notice how the moving average remains above the price action of the falling stock, thus indicating that the stock is in a downtrend. It is very easy to figure out the direction of the trend when using moving averages. You can identify trend by using any of the following three ways: direction, price, or crossovers. The first is the simplest way to identify trend, using the direction of the moving average to determine the trend is as straightforward as confirming the moving average is either rising or falling. If the moving average is rising, then the trend is considered up. But if the moving average is declining, then the trend is considered down. The second method for identifying the trend is by using the location of the current stock price in comparison to that of the moving average. If the price is above the moving average, the trend is considered up. If the price is below the moving average, then the trend is considered down. And the third method for trend identification is based on the location of the shorter moving average relative to that of the longer moving average. If the shorter moving average, for instance a 5-day moving average, is above the longer moving average, like a 20-day moving average, then the trend is considered up. If the shorter moving average, however, is below the longer moving average, then the trend is considered down. In any case, it is important not to act on every subtle change in trend, but instead look at the general direction the stock is moving. But let's not shortchange moving averages. They can do more than simply identify trend. Moving averages are often used to forecast areas of support and resistance, and are also used in conjunction with other indicators to help give more accurate entry and exit signals. Traders often use moving averages to help them choose strategic areas to set price targets or stop loss orders. However, it is important to note that, like with all strategies, moving averages work most effectively when used in conjunction with other indicators. Now, in technical analysis, there are three different types of moving averages: simple, exponential, and weighted. Each, due to the way they calculate the average, form a slightly different trend line. When comparing the three different types of moving averages, there is no clear winner that works best in all circumstances. However, with intraday trading strategies, we prefer using a weighted 5 and 20 period moving average on a 2-minute chart. The 5 is used to trace the price action of the stock, while the 20 forms a smoothing trend line. Ultimately, which moving average you will use will depend on your trading style. The simple moving average's biggest flaw is that it has a noticeable lag, but exponential and weighted, which are prone to quicker breaks, are susceptible to more failed signals. Therefore, if you are a short-term trader, then a weighted moving average will most likely work best for you. However, if you are a trend trader that likes to have a stock pattern develop over time, then a simple moving average may suit you best. It is also important to consider the stock you are looking to trade and how it has moved over time in conjunction with the different moving averages. By doing this, it will help you identify what is the appropriate length of time to use for your moving average. You can conceivably have a moving average set for any time period, but the most popular include the 5, 20, 50, and 200 period. Each has a different purpose. However, the longer the time period, the more prevalent or meaningful the trend. If you notice that there are too many crosses through your moving average, then lengthen the time frame used in order to decrease its sensitivity. If instead you find that the moving average is constantly reacting too late, then shorten the length of time of the moving average to increase its sensitivity. While greater sensitivity leads to quicker signals, it also leads to more failed breakouts. As a result, there is an unavoidable trade-off between sensitivity and reliability. The shorter the moving average you use, the more signals that will be generated. While these signals may be timely and effective some of the time, there's also going to be an increased amount of false alarms given due to the increased sensitivity. By using a longer moving average, you decrease the sensitivity and have fewer, more reliable signals. However, remember, with less sensitivity, the signals are often given late. The weighted and exponential moving averages, which are generally much more sensitive than simple moving averages, generate more signals as they are consistently closer to the actual stock price. However, the downside with using a weighted and exponential moving average is that they also give an increased number of false signals compared to a simple moving average. Keep in mind, though, that in some cases a stock price movement is too erratic and choppy to use a moving average, regardless simple, exponential, or weighted. If there is no evidence that a stock is respecting any sort of moving average, then it is probably best not to use a moving average for analysis of that stock. Always remember that moving averages are not going to be perfect. They are expected to lag to some degree regardless of the time frame you use. However, because of that lag, they are extremely helpful in identifying a stock's current trend. With the trend identified, many types of trading setups arise. Understanding which type of setup is best to use in each scenario can create trading success. It is important to note that stocks, sectors, and markets spend the majority of their time in trading ranges, which render moving averages ineffective. Only after a trend is developed is a moving average going to be useful. Remember that a moving average will keep you in, but also give you a late signal to exit. Therefore, do not expect to get in at the bottom or out at the top. Moving averages alone are not enough to permit entry, but when used in conjunction with other tools, that to confirm decision probability dramatically increases. Now, it is common to see a stock draw a lot of attention when price action touches its moving average, especially after the stock has trended in one direction for a substantial period of time. Traders consider this a potential pivot point in which the stock can make one of three moves. The first being a successful bounce off the moving average as the trend holds. Through the use of moving averages, it becomes much easier to identify support and resistance levels, especially in a stock with a significant upward or downward trend. In this illustration, you can see that the stock bounces off the moving average, which is acting as support, and continues higher. This dramatic bounce is caused by traders coming in to purchase a stock near or at its moving average. Traders long the stock as they look for the ascending moving average to act as a technical level of support. Let's take a look at some examples to help get a better understanding of this trading setup. Here is a snapshot of Quest Diagnostics, ticker symbol DGX. By looking at the chart, we can see that the stock has maintained a price above its weighted 20-period moving average on a 2-minute chart. This strong uptrend has carried the stock over 3.5 points higher on the day. Taking a look at another snapshot of that same DGX chart, we can see that buying at or near the moving average is absolutely critical to a successful trade in that stock. Even though the stock is up almost 4 points on the day, every time price action diverges from its moving average, the price snaps back to the moving average. Therefore, the truly opportune time to purchase a stock like this one is at or near its moving average, which is acting as an ascending support. In the next example, we see Wendy's International, ticker symbol WEN, down about 3.5 points as the stock price cannot break through the moving average, which is acting as a descending level of resistance. When a stock is moving in such a manner as this, avoid taking a position against the trend. Instead, look to short as the stock tests its moving average. Remember the famous saying, a trend is your friend until it bends. Okay, moving on to the second possible move that is the most troublesome for traders. The stock hugs the moving average and consolidates. After a substantial move in one direction, it is common to see very strong or weak stocks resist reversal attempts even after the moving average is breached. In this illustration, the stock price crosses the moving average but fails to reverse trend. Due to the choppy and indecisive actions of this type of move, it is imperative for traders to avoid trading such a pattern once you have determined that the move has unfortunately consolidated around its moving average. And finally, the third is when the stock price crosses a moving average, or two moving averages cross each other, which is referred to as a crossover. This cross is considered a signal of reversal in trend and an early indication of future momentum in the opposite direction. In this illustration, we can see that once the stock price trades through the moving average, an immediate sell-off occurs as shorts enter and longs exit. This downward momentum reverses the stock's trend from up to down. Let's take a look at some examples to help get a better understanding of this trading setup. Here is a snapshot of TCF Capital, ticker symbol TCB. After a 2-point up move in the first hour of the trading day, the stock consolidated slightly above its 20-period moving average at $19.50. Once the price successfully crossed below its moving average for the first time that day, the stock quickly fell as this indicated weakness. Quickly, the stock changed from an uptrend to a downtrend. Taking a look at that same stock just 1 hour later, we see that the price has fallen about 1 point since the cross of the moving average at $19.50. Moreover, we now see that the moving average, which was previously acting as support early in the trading day, is now acting as resistance. Taking one more look at TCB just a few minutes later, we see that the moving average, which was acting as resistance, is now broken, thus compelling shorts to cover their positions and enticing buyers to re-enter as the trend has once again reversed, this time from a downtrend to an uptrend. Moving on to the next example, we see AMB Property Corp, ticker symbol AMB, deviate far from its moving average first thing in the morning after a $1.50 move up. The stock then consolidates near its high for a short period of time before crossing its moving average for the first time that day. Due to the aggressive spike up in the morning, there is a lack of support levels in sight, which causes longs to frantically exit their positions and entices shorts to enter. This cross from an uptrend to a downtrend through the moving average moves the stock price down over 90 cents before once again reversing trend. Through these examples, it is evident moving averages, when identified correctly, can produce some truly profitable trading setups, whether it be a bounce off the moving average or a cross through it. With either setup, a discernible trend should already be established before participating. This will increase the likelihood of a successful move, whether it is a bounce or a cross. Moving averages are one of the simplest and yet most effective tools technical analysis has to offer. Utilize them wisely. Don't just use them to identify trend, use them to also identify ideal entry points.